So hi, everybody, and welcome. And I'm sure we're going to have more people come into the room, and we'll have them introduce themselves when they arrive. I'm Bonnie Halper. I'm a super connector, and I write the weekly Startup One Stop newsletter and have done since 2009. And work with entrepreneurs to help them shape up their pitch deck, make introductions to investors. And you all need help with your pitch decks and your executive summaries and your elevator pitches. We know that. I'll look at Nick, and you always have to change it like at least 100 times, right, Nick?
Right.
It's never finished. It's never right. And every 2 weeks we host a breakfast, and online now. We used to have them in real life at Kettle Space, our favorite co-working space. And Nick is our guest this week, and I'm going to have Trevor talk about Kettle Space a little bit, and then we'll introduce Nick.
Hey, I'm Mac Mayer. I'm the event director at Kettle Space. So Kettle Space is New York City co-working community. We just launched the app. You can find all things Kettle Space. Right now we have 3 locations open, Midtown East, Nomad, the Wilson and Nomad, Roger Smith Hotel in Midtown East, and Bar in Lower East Side. So if you download the Kettle Space app, you can check in, and we're going to be adding a ton more spaces in the coming weeks. So I hope to see you guys in our spaces. And that's it for me.
And by the way, Barbara has amazing Indian food. Amazing. Really
oh yeah.
So Nick, would you like the entrepreneurs to introduce themselves first, or do you want to talk about yourself, your background, the fund that you're looking for? Up to you.
Yeah, I mean, I guess
you want them to start if you'd like to start.
I guess I'll be fairly quick, and then I'd love to hear them. I could jump right in. So hello, everyone. Okay. Really, such a pleasure to be here, Bonnie. Thank you for having me. It's always fun when me and Bonnie get together. So really happy to be here. And I guess a little bit quickly, I'll start with my fund. So I'm a VC at Nanban Ventures. We're a fairly new fund. We just started deploying capital in April of this year. We're ready. We raised about 50 million, and we're ready to deploy capital. We haven't made our first investment yet, but pretty close, and we're actively screening deals. So I would love to hear about all your startups, what you guys are working on. Would love to connect. I dropped my email in the chat earlier, so feel free to shoot me an email if you want to get coffee or a Zoom meeting. And our check size, we invest in all verticals of technology, and with check sizes between 250K and $1 million. And then I guess just quickly about me. So I started my career in investment banking. I did the 2 years, whatever, of the hard labor and the work. And then after that, I started my own startup. It was called Polliticly. And what it was a political data company where we sent IP-based demographic information to elected officials, political consulting firms, and sort of political groups. And recently just sold that this year. And sort of the next step after you're a founder with an exit, I figured why not go into VC? And I'm really happy to be here, and a pleasure to meet you all.
Also, that's good because Nick already went through the pains of founding and starting a company, so he can understand, and he will know your struggles.
Oh yeah, of course.
So Abbeys are first. The Abbeys are always first.
Which Abby do you want to go first? We've got Abby Sugar and me.
You, I know, because Abby Sugar is second on my list. You.
Okay, hello. Nice to see everyone. And so impressed with your exit for Polliticly. If you have time to share, it'd be great to hear more about that as well. My name is Abby Ludwise, and I am working with a co-founder on a luxury home hygiene product that focuses on creating a ritual of well-being for the home.
Thank you. Oh, next, Abby Sugar.
Hi, congrats, great to be here. My name is Abby Sugar, and I'm the founder and CEO of Playout Apparel, which is gender equal streetwear and underwear. So we do not have men's or women's sections, but we encourage people to shop by style, not by gender. And we're focused on a whole new shopping ecosystem for the 56% of Gen Z that shop outside of their assigned gender. Thanks so much.
Awesome. Great to meet you.
Buddy Love, whose real name I do not know, but maybe Buddy Love will tell us.
Oh, hello. Daryl Bester. I'm the founder and CEO of Buddy Love. We are a cannabis lifestyle community company where we look at all the verticals inside the cannabis industry. But right now, since I'm in Illinois and they're blocking all the laws and rules, we had to take the backside and go into CBD. So we're actually doing our launch next month for our general wellness, and we'll go from there. We'll see how we can move about in the community.
Oh, good luck to you.
Great job with the pivot. Really smart. That's awesome.
Definitely. Thank you.
Every company pivots, right, Nick?
Of course.
Kara.
First, Buddy, what did you say your real name was?
Daryl Bester.
Daryl. Okay, so move to Vermont because it's no hold bars over here. So I'm Cara Terrell, founder and CEO of Core4 Parenting. We are an early childhood education course platform in the tech ed space where we support the parenting personal development and follow the age and stage of the child while teaching the parent how to be their child's first teacher from prenatal care to 5 years old.
Thank you.
Incredible.
Harshal? Hope I'm pronouncing your name.
Yeah. Hi, Harshal this side. I am the founder of startup Tusker.ai, and our overall vision is to make AI possible for everyone. And like we are creating an automation framework for image and video surveillance industry, specifically to computer vision. So we make computer vision models with our framework within few hours. So a complete pipeline, we are automating the complete computer vision pipeline. It's like no code computer vision kind of thing which we are making.
Cool.
Thank you. Jimmy. Names keep jumping around.
Yes, right. Too much security on my end with covering up the camera. But great to see Mac again. I think Mac, we worked together on that prototype marathon we did maybe a month or two ago for Kettle Space, which was a fun exercise. I'm working with one of my good friends. We're in the initial stages of trying to commercialize his research as an academic in natural language processing and machine learning. And we're really trying to focus on what is the right problem set. He's very good at extracting narratives from large amounts of data. And his research focuses on predicting flu outbreaks using Twitter data. So I'm really kind of in the initial stages of finding what are the most attractive problem sets where we can get the right amount of data to play with.
Wow, thank you.
Wow, it's fascinating.
Yes, it is. Mike, welcome.
Hi, Bonnie. Good morning. So my name is Mike Riscala. I'm CEO and co-founder of Snorble. What Snorble is it's a little robotic companion for kids, for young toddlers. And what we do is essentially we inspire their minds through magical experiences in order to help them establish healthy habits. We focused on sleep as our very first kind of healthy habit that we've kind of honed in on. We raised $1 million in our angel round in 4 months during the pandemic. We launched in Indiegogo, which in 20 days we did $200,000 in pre-revenue and sold 1,000 units. And now we're raising a $2 million seed round. So we're in the process of that. We're 40% committed in under 2 weeks. So that's where we're at. I'd love to talk with you, Nick, as well too, if you're open post the call.
Of course, yeah. Let's do it.
All right, cool.
I have to scroll down to the next name. Oh, Neil. Oh.
Hey, hi, sorry, I had just logged out for a moment.
I saw that. I let you back in. Do you want to introduce yourself?
Thanks.
To the group?
Sure, sounds fine. So hi, I'm Neil Vora. I am based out of Mumbai, India presently. I'm a fund manager at a large family office in India, and we do both private and public market investments. We do strategic investments as well. I've been in the tech VC world for many years now. I'll be moving to Bay Area pretty soon, and would love to connect with all you guys over there. I'm right now on a mobile. I'm at an airport lounge, so that's why the background and the mobile version.
Oh, well, thank you for joining us. Scott Purdy.
Yes, good morning. If it was Saturday night, I'd be the third Abby, but since it's Thursday, I will be Scott from Sine. And I'm envious of Kara because she's where they have the great maple syrup.
Yes.
So very lucky for that. But let me, for those who don't know me, and Nick probably hasn't seen me before, I'm one of the founders of a company called Sine. And what we are is we have an app that will go on your phone and on your computer that will allow you to make professionally made movies and videos. Now, I know there's a lot of ways that you can make movies and stuff using iPhones or your other phones and all, but we believe we're going to be first to market with our concept. What we're going to allow you to do is multiple people, there'll actually be a project manager will start a project, invite multiple people. You can be anywhere in the world. Everybody can take videos, or if you're an event, take videos, put them into the system, and the system through the use of AI and machine language will automatically pick the best shots and the best, and actually whatever you tell it to do, to look for, and make a professionally made video in a very, very short amount of time. We believe that we will be first to market with this type of concept. We've been working with a company based out of Pennsylvania called Brick Simple, who is helping us develop the app, where we're basically right now ready to use it to show investors what it can do. But we will need the investments in order to, get all the AI machine language refined in there so that, let's say, you could go in and say, pick the best shot of a wedding cake at the thing, or pick everybody that's wearing number 5 on their shirt, pull it together and make a video and have it that. So we're ready to get investment, and then hopefully not long after that, we'll be ready to launch it to everybody.
Oh, awesome. Trip was the first one in the room because his name starts with a T. It's always last. So I'm gonna move Trip up a bit. Okay. Yes.
My name is Trip Braden. I'm currently working on a startup with social audio. We're launching July 21st out of Germany. So it's kind of exciting for me. I've worked on the other side of the desk for years. I've bought 70 companies, strategic acquisitions. So now I'm getting on the other side of the desk, and we're looking forward to launching it. But it sounds like we've got some great entrepreneurs. And I also, if you don't recognize me, because you see me now versus Clubhouse, I also co-host the program with Bonnie. So thank you.
Thank you. Tommy.
Hi, good morning, everyone. I'm working on my name's Tommy Jenkins. I'm working on a dating app right now. I think all of the dating apps I've tried are basically broken, and I think everyone I've talked to agrees. So that's really exciting. I just started that, but I have a background a little bit in finance, a little bit in operations, community work, data science, and AI, and I've been coming to Bonnie's events forever. So thank you for having me.
Great to meet you.
Nice to meet you.
Serge, did I ping you yet?
Not yet. Good morning, everyone. I'm Serge. My company, Extreme Mobility Living, is on a mission to help solve housing affordability crisis. We want to help 1 billion people to have affordable housing. And I want to share great news. We just got a US patent granted for a 3D printer. We're going to 3D print high-rise buildings. And we are looking for impact ESG fund to lead the finance round. Thank you.
Thank you. Crypty, Andrea.
Hi, sorry there. I'll go on camera. I'll go back on camera soon. Good morning, everyone. My name is Andrea. I used to practice law, but I've been representing a Hong Kong family for the last 2.5 years. We typically make direct investments into anything with a disruptive element across different industries. More recently, I've been pushing for fund exposure, but that's been a little bit tricky. When it comes to private equity, I think it's actually super interesting. And on occasion, I get involved in biotech deals that involve potential acquisitions and OTC uplistings. So I'd love to kind of learn more about what Nick is kind of working on, and would love to learn a little bit more about private equity. Yeah, thanks.
Thank you. So I think we got everybody for now. Questions? There are always questions.
Yeah. I guess. Oh, good.
Oh, Nick, I was going to say, typically, since you're looking, and I guess you have on your way to do your first investment, are there areas that you prefer to go in? Or are you open to different, like, do you like tech? Do you like medical? Or you're pretty much open to any idea that you think is really good?
Yeah. So and that's, I think that's an interesting concept. So we're a fund that's at the beginning of our life stage, where we're really learning what works for us, what doesn't work for us. So I think at this point, we are really open to anything and everything. And it's important to note that our investment thesis is seed to Series A deals, but we've screened pre-seed deals, we've screened Series B deals. So we're at a point where we're really open to anything and everything. And then even if it's a deal that's too early, we still want to meet those founders maybe for the next round. So at this point, I think the answer to that question is we're looking through all sectors of technology, even nothing like biohealth, where we've seen some, but we're not experts there, but we're still screening those deals as well.
Thank you. Next. So I know you're doing early stage. Are you holding back? Are you saving some for possible next round too? For early stage investment. Investment.
You cut out a little, Bonnie. I didn't hear you.
Oh, I'm sorry.
Yeah.
Maybe I should shut off my video because we had that electrical storm, so it's been a little weird lately. Mm-hmm. So are you also planning on doing the next round too, or putting into the next round as well?
Yeah, so that's sort of what we are looking for. So like I said, we're early. So right now we're not leading deals. We're looking to be co-investors. However, by the end of the year, we're looking to lead our first deal. And to Bonnie's point, yeah. So when we invest in the seed round, let's say we'll put a $250K check in, there would be the hope that we get a more significant portion of the Series A. So sometimes those, and same thing with pre-seed, we would invest in a pre-seed deal to get that really good exposure at a later round. Yeah, Abby.
I'll pop in. I think that your experience and your experience as a founder now moving into VC and investing is really helpful and awesome. And I know, I'm actively raising our round. So we're doing a pre-seed round, 35% committed actually. And as Mike said, he's had great success recently. In terms of finding your first, raising your first round as a founder, do you remember that process? How was that for you? Do you have any tips from both sides?
Yeah, of course. So, and I think I'll tell a story here too. And I think, I forget, it was Daryl who brought up the concept of pivoting. So a real interesting story. So what my company was at its inception was, it was a consumer app where you could directly get in touch with your elected officials, your vote on polls and things. In theory, that's a fantastic idea, but consumers don't really care too much about politics. So we realized that we raised a small angel round from a few angels I knew, that was just very small round. And then we decided to pivot toward a political SaaS product. So that pivot took a few months. And then right after that pivot, when we got some traction, we were working with some campaigns, some political consulting firms and we pivoted our SaaS product to be IP-based polling, where elected officials and consulting firms could just pull data from our product. That's when we started raising our pre-seed round. And it's not easy. It takes up a majority of your time, while you're building your product. So I once asked my mentor a question. I said, how much time should I focus on raising money versus how much time should I focus on building my product, getting more clients? And he told me this. He said, you need to spend 100% of your time building your product, and you need to spend 100% of your time raising money. So interpret that as you will, but that few months period that you raise is probably the hardest thing a founder has to do, because if you're passionate about your product, it's going to be easy to build. That work just comes to you. But no one likes raising money. It sucks, to be honest, and investors could be difficult to deal with. But I think the main key there is be resilient. Reach out to anyone and everyone. Twitter was my biggest resource, where I would just send investors Twitter messages, and that really does go a long way. And I'm curious to hear what other people in the room think, where this concept of like submitting your startup through the investor's website, that's never really worked for me. But that same investor, if I send them a cold email or send them a Twitter message, they'll more likely respond. So that's one little secret I found, and I wonder if anyone's had that same experience.
You know, the advice that most investors recommend is a warm introduction as opposed to a cold email. But you're like me, you're pushy.
Exactly. Yeah. I think that's the one way to succeed. If you're pushy, there eventually something will hit. You'll kick it off with an investor. Abby, I think I may know someone or a few angels that might be sort of in that realm that are interested in investing in that. So let's connect.
Yeah.
Yeah.
That would be amazing. A few, I would love to connect with you, because I was actually going to ask my follow-up question on what you're suggesting, is that because as founders and as the CEO raising the money, our time is so limited and so overwhelmed, 100% building the product and 100% raising money, right? I've gotten some advice saying, don't do 15 or 30 minutes with somebody who's not a potential check writer. But I actually have found the opposite to be more helpful, because if you go into a conversation looking for authentic connection and with whatever opportunity may come. So if we're talking about wins as founders, my co-founder and I were featured in the New York Times last week. And that conversation, that interview, that article came out of a conversation with a VC who, because I'm tech enabled, we are building a community app as part of our content and our clothing apparel brand, The Future, but I'm not a SaaS company strictly. They weren't able to invest because they have a mandate for their LPs, but the VC I spoke to wrote for the New York Times, and 4 weeks later said, I want to write about you. Do you have time for an interview? And so you just never know. I don't know if you had any experiences like that.
That's incredible. And that's something, and congrats on that piece, by the way. That'll make sure you try to sneakily post the link to that in every email you send. That's definitely, be proud of it. For me at least, I would take every single meeting, even if it was a person who wasn't an investor, but maybe just wanted to, hey, I'd love to know more, because people are helpful. And there's this theory that people want to do good for other people. And if you go in with that mentality, and you also can offer things to that person, and things go both ways. And just, take every meeting, even if it takes up your whole day for this short period of time, it's worth taking every meeting. And once you raise that money, then it's back to grinding, taking all those client meetings, those customer meetings, those user feedback meetings. That's sort of how you do it. But now do it balanced now, but take everything.
Yeah, thanks for your perspective. Amazing. I'll definitely send you an email. Would love to talk more.
Yeah, of course.
I know that Sergey has a question, but thank you so much for bringing up mentors and advisors. I do want you to talk a little bit about that, but I know that Sergey has a question.
You guys mentioned you don't lead, but do you guys help finding a lead?
Yeah, we help find a lead. Yeah, we would. We're in the process of helping find a lead, and I mean, we're just as good as you. Maybe we have more connections, but yeah, we would definitely help companies who are interested find a lead.
Thank you so much.
Yep.
I have to go, so thank you so much. Have a
Yeah.
nice Zoom meeting.
Yeah, send me an email if you want to connect. Great to meet you.
Yeah. Thanks. Bye.
Hey, Scott.
Yeah, hi. I just want to say on what Abby said, in my younger days, I was always, when I would take every job interview I could get, even if I wasn't interested, because it's practice, practice, practice. But my question to you is, do you typically, and I guess it might depend on the size of your investment, what percentage of stock might you ask of a company? I mean, do you have a limit on what's the most you would want or what's the least you would want, depending on the investment?
Yeah, cool. And yeah, same thing on that. Like when I was trying to get into banking, I would literally take every single interview. And if you're looking for a job, just take it. And those job interviews that like you took in your prior career, that these actually prepare you for investor meetings. So experiences really connect. But to your question, yeah, I think percentage in terms of equity, I don't think it matters. There's this theory. So the Box Group, David Tisch, he has this thing where he doesn't really care about equity as long as he has a piece in the company, and the equity, if there's going to be a unicorn company, your equity percentage doesn't really matter because you're going to get that on cash return. So yeah, we don't really have any, I'm sure we don't want 40% of the company, but anything reasonable we would go for, and equity is not a make or break for an investment.
That's a question we've been banding around among the other founders of how much and at what point does it become too much, depending on the amount, the amount. And I think I've heard over this, like 15%, depending on it, is kind of like an average amount, or.
Yeah, that's probably about right. Or what are you raising a safe, or what do you?
Well, we've been pretty much bootstrapped since we've been in. We've all self-invested. So, that's just that we're ready to get a seed round or go right to A, depending on the interest of the people, how much they love our idea, and how much you're willing to commit. I said basically most of the money would go to the AI development, and then try and have some staff on board, like someone who would be a paid staff member as opposed to all of us, doing it now for no money.
And I guess that's the thing. So in terms of the terms you want to like your founder's cash equity and founder's sweat equity, that goes a long way. And I think it's good to be upfront with investors and tell them what you're looking for. So if you don't want to be screwed on terms, without saying that, you kind of have to make your way to not being screwed on terms, and really study up on what similar companies are pricing their rounds out, how much equity they're giving out, because you don't want this crazy. But most times VCs know the market and won't really try to take too much or take an unfair terms. And there's always negotiating and countering back, but definitely consult legal on that, I'd say.
Okay. And do you look for like the end game, like if there's an exit, or whether they want to just run the company long term?
Yeah, I mean, when we look at deals, we look at like an exit timeline. Eventually we'd want an exit. And if you want to run the company long term, when do we think it's going to go public? Will it go public in 12 years? So in terms of like SaaS businesses, that they have like an average lifetime of 5 to 7 years, they might get acquired. So that's sort of what we look for, is does it have the potential to get acquired within the next 7 years based on what the market's doing.
Thank you.
Yeah. Cool, Mike.
Hey Nick, I was just wondering, what type of vehicles do you guys prefer in terms of a transaction? Is it, I know like we're running a safe, for example, but and also, do you prefer priced rounds versus, whatever, like convertible notes, or just wanted to hear more about that?
Yeah. I love safes. Nanban loves safes. I can't speak for everyone else in other VC firms, but we love safes. They're simple, especially for a seed round. There's no reason to price around, but a valuation cap. We like to see a pretty fair valuation cap on the safe. But I really think and convertible notes, there's more legal fees. So just for a founder, a safe is just so much easier and so much more fluid. So I think you'll be fine with a safe.
Sorry, and I have another question too, just in terms of like the when you're looking at the opportunity around valuation cap. Do you like, because we basically put together a bunch of comps that we ship out, you know, when we hit that part of the conversation. How do you guys usually deal with that? Do you guys have your own analysts in-house, or do you wait for, I know you said that you wait for a lead to come in. Well, and I guess that's the second part is, do you make commitments prior to a lead, you know, like upon a lead, you know, that type of thing?
Yeah. So if we haven't done that yet, but if we love a company, we would make a commitment prior to a lead and then also work with them to help find a lead. So if we love the company, yes, we would do that. And so we haven't priced the valuation cap yet, but I think most of the time, a founder works closely with the lead on that. So just what is a fair valuation cap? What are other seed deals doing in similar verticals? It's also based on traction. If you have this really big traction event right before your seed round, that'll raise your valuation cap a little. So I think there's no real advice on that, and I think it's just what the market says and what the lead says. And it's really all imaginary if you think about it. There's no real tangible way to value such an early company. So it's what's fair, I believe.
I like that you said fairness because, you know, if a founder is working 500 hours a week on something, and then as an investor, you come in and say that you want 40% of the company, what is the inspiration? What's the momentum for the founder to continue doing that and continue killing themselves? So there has to be understanding on both sides. And I've been reading a lot about, you know, founders making sure that you're intentionally seeking out aligned investors and asking investors questions just like this. So I really appreciate how you are answering the questions and approaching this.
Exactly. And that's the thing. And this is something I truly believe in. I hope this is the standard. You're investing in founders almost more than the company. And you want these founders to be happy. So if you give them unfair terms, your money that you're invested in the founders aren't happy. So they're going to work less hard. So you want your founders to be comfortable with fair terms, and happy founders leads to successful companies.
That was ties really well into my question. And I'm a newbie here, but that's what I'm hearing is that the tide is turning and there's a working relationship between founders and investors. What is your take on the level of not financial investment, but cognitive and directional investment that you intend to have with people you fund?
Yeah, and that's a great question, and something that we believe in at Nanban, and something I'm passionate about is we don't want to be just a check. We want to be those value add investors. We have a group of portfolio advisors who we supply as mentors to founders, plus myself, our director Sheesh, and our GP Kuchral. We're all there for our founders, whether it be an ask, whether that be introductions to potential clients. We really want to be not too hands-on where we're in the mix because it's the founder's job in the end, but we want to be there on request, or if something comes up that we think, hey, this would be great for X company, we're gonna go ahead and make that introduction. So I think there's a good mix of letting the founders sort of take their own journey, but also being there as that rock to support them. Yeah, and you had two questions, or what was that?
I have my second question is that things are on a super fast track, right? COVID created the opportunity for me to come to write my curriculum, and here I am a year and a half later, and we're a team of 5, and it's amazing how fast it's happening. And so we're actively looking to create an advisory board with the high level of skills in their educational background that represent the broad work that we do with early childhood development. What is your when you look at a company who has an advisory board, does that add value for you? What does that mean from an investor perspective?
So I've heard like many things about this. So I'll give you my personal opinion first. I think advisors are mentors to a founder. That's what they are. Mentors are great. I couldn't have done what I've done without I had a group of 5 really core mentors who walked me through like things almost on a day-to-day basis, who are really there for me. So it's I see it as a real value add, especially if they have credentials and all these like advanced degrees and experience in the industry. However, they're not part of the team. So yeah, some people see it as, why are these people here for you but not investors? And but I don't know, I don't see it that way, but I've heard people see it that way. I think it's one slide, maybe in the appendix, you want to just do who your advisors are, and then maybe like a blurb about them. Maybe not in the appendix, put it in the slide. I think it's definitely a value add, but I've heard mixed things, but I think it's a value add. I guess, Bonnie, what do you think about that? Have you heard about that?
I never heard about putting them in the appendix, but I always tell people they need advisors, especially those who are subject matter experts. And it's a plus for the investors too. They want to know that you have people on your team who know what they're doing.
Yeah, agreed.
If I could add to that, you know, one thing to take note of just in terms of advisory is that I look at advisors as potential people that you might want to bring on team that have an incredible background, you know, but you don't have the capital, you know, because obviously if you're bringing it, like we have one of our advisors, he's a PhD from Stanford. He used to advise Steve Jobs. He actually built the learning program for Apple, right? So we can't afford to bring him in now, but the plan is upon receiving X number of capital in the future, he would become, you know, on team, right? And I think that that's also great. With the other thing too is that if you know, we have advisors that have invested, right? So that's also because they have a vested interest in what's happening. Two members of our advisory board have put in substantial capital. So my personal opinion on that is that if you have people of incredible value, well, you know, there's an opportunity there, and you have to give them something. There has to be like a, you know, that's kind of how I approach it anyways.
Yeah, that's actually that's a really good way to think about it. I like that, Mike. Yeah, agreed.
Nick, when you're looking at a company you might be interested in, do you value the team or the product, one more than the other that you see which would want you to invest, or you kind of have them equally in there?
Yeah, I'd say it's equal. I think team maybe slightly over product, unless it like the product is like totally ridiculous. If it's a decent product, the team is really what sways the decision. A strong team can build amazing things, and with a product, especially in the early stage, that product can pivot. That product can be advanced with a good team. So I'd say team is really there. And also, I guess a quick story. So something we look at is how we connect with the founders of the company. A good story. So I won't say any names or anything, but a few weeks ago, we had a founder come to us and excuse my language, but a real asshole. Like he was, he came in with a really bad attitude, but he had a $100 million exit for his previous company. So incredible exit, huge exit. Like he's a successful person, worked for like huge corporations at executive levels, but he came in really not nice. And what he was building was pretty cool. It might've had some potential, but the whole meeting super aggressive, asking for an expedited process, asking for an answer on the spot, and just sort of being very hostile if we asked too many questions. If we asked for the deck, he said, I'm not going to give you the deck unless you give me an answer. So really bad meeting. So yeah, you have to just be like a good people get more from us. So that could have been a really great investment, but we decided to decline because of just because he wasn't a good person and wasn't connecting with us, right? So just being genuine with the investors and being open and honest, that can go a long way, because human connection is really what matters in this business.
Nick, can I ask
yeah.
the question? That's okay.
Yep.
You know, in terms of what, like you mentioned, kind of like the asshole scenario, right? which is you know, that's actually not that uncommon on both sides of the fence, I think, depending on the situation. But what is it that you look for that's like your, you know, that's the secret sauce? You know, because I know usually what I see is that a lot of the VCs have their ratings metrics or their matrix, right? You know, and without, obviously I know you have, that's some of your own IP, but without kind of giving up too much, how do you go through your evaluation of a company in order to make that decision of like, yes, this is something, you know, is it risk? Is it, you know, what's the big thing that kind of deters you or brings you on board?
Yeah, and I think, I'll be happy to walk you through sort of our process and our thinking, and mine particularly. So for me, decks can be, when I first, before I meet a founder, I look through the deck, I read the deck, and I don't make a decision based on the deck. I just get a really good understanding of what the company is. And then in that first meeting with a founder, I ask a few questions. I hear the company from the perspective of the founder. And I think right there on the spot, I can get good conviction of whether this can be a potential investment or not. If it's not a good fit, I like to right away be upfront with the founder. Maybe the next day after I give it some double checking. So we like to do fast turnaround if it's not a good fit. But so you get a good understanding if it's a good investment, and you want a follow-up meeting just from the first interaction with the founder. So let's say we say, yes, all right, we want to take this to the next level and do a deeper dive. So if we do that, we're interested. We think this could be a potentially great investment. It has a great product. It has a great team. And then we go into the financials. What's the potential? Can this grow to $100 million by 2026? That's not our quota, but like usually we like to see significant double-digit growth by the outer years if they model it out. So I think the answer to that question is the first meeting, we have a real good sense of what we want, what we're looking for, and then it's a matter of doing that deeper due diligence, doing that deeper analysis, taking a look at the market. Is this a market we want to be in? Is there M&A activity in the market so we could have a potential exit in the next 5 years? But then we go from there. But the quick answer to that is we have conviction in the first meeting.
I guess a follow-up to that, please. So I've done a number of live pitches, well, live via Zoom, obviously. And so the deck doesn't stand alone yet. It all has the voiceover from me. And when you look at standalone decks, what jumps out at you? Do you like to see video in them? So live pitches, I've really limited myself to 5 minutes or less. But when you're looking at a standalone deck and you have your own time to look, is there a length that you prefer? Is there a format you prefer?
Yeah, and good luck with those. I actually, and speaking of Zoom really quick, I had my first in-person pitch last week, and it was so cool. It was really cool. It was, so that's off topic, but so standalone desks, I think you don't want it to be too long. You don't need this deep analysis. So something that every founder, and I believe it is every single founder, myself included, goes too deep into what their product is. There are slides on features, different UI, UX things. Sometimes you get way too lost in the features, where if you could do 1 or 2 slides on what your core product is and what the value add is, I think that's enough. And don't get lost too much in the features and the benefits and all the sort of like bells and whistles of the product. So I think there's a good template that I could, if you guys email me, I'll send it over to you, of like 10 slides, and it just goes over the the product, what the TAM is, what your business model is, something about the industry, something about the team, and it's really quick, 1, 2, 3, like probably 10 to 12 slides.
Yeah,
really tell a lot about your company, and you don't need this super huge deck.
Oh, send it to me. Send it to me. I want to include it in the newsletter.
Okay. Yeah, I'll send it out. Yep.
And then in that space, I know that when I've pitched before, people have said, well, where are you in your traction? So I'd love to know your definition of traction, because we are actually launching our first marketing campaign and our first saleable product in 2 weeks. So we don't have revenue traction to show, but we have all of this founding and team building traction to show. Are they equivalent for a founder?
That's a fantastic question. Yeah, everything is traction, and that's the way I see it. So what milestones have you hit along your process, and what is the most recent milestone? And a simple way to think about that is, what's the most recent thing, or the few most recent things that got you super excited about the product and about the business, and include that. And the odds are the investor will also find those things exciting. So any advancement or any user or even pipeline, like some things you have coming up that you confirmed, or you have somewhat proof of confirmation that they're coming up, include that too, even if they didn't happen yet.
As a follow-up to her question, which is where I was leading, was like users versus revenue. We bandied about whether you want to charge a minimal price for the app, but I think we want to have it free to users and build up a lot of users. Instagram and Facebook, and none of them ever charge the users. So that's one of the issues that we're at, is when we're presenting to somebody, we are not going to have revenue, but we hope that we will build up users quickly and get enough users that someone will be interested in acquiring us at some time in the future.
Mm-hmm. Sorry, go ahead.
No, I was going to say, so is that a situation you consider, even though someone's not actually generating revenue right at the beginning?
Yeah, I mean, and if you're a seed stage, pre-seed stage, even some Series A companies, if you don't have revenue, that's totally fine. Most seed stage companies don't have revenue, or have like 10,000 revenue. Like in the VC world, there's no difference between having 10,000, 20,000 annual revenue for zero revenue. As long as you have that user traction and you're showing promise that maybe you could hit revenue in 1 to 2 years and maybe grow that exponentially. So it's about once you hit revenue, how much revenue growth can you have? So yeah, I don't think, for me at least, there's not much of a difference at the seed stage between no revenue and minimal revenue. And we really mainly look at in your case, it would be the user traction. And another big thing, if the churn rate, so an active user, so how many people that you bring on are staying on.
Hey, Nick. Oh, I'm sorry. Who wanted to go in? Somebody wanted to go in?
Go for it, Daryl.
Okay, thanks a lot. Now with cannabis, because at some point, you have to look at it as a commodity. So now, how do you feel about that? Because I specifically chose the name Buddy Love just because it's reference to the Nutty Professor. But at the same time, when you're in cannabis, you think about you buddy, you're sharing the love. That's what we came up with, Buddy Love. Probably the best love in the world. That's our tagline. So with that, I'm more so on marketing, because at some point I know marketing is going to prevail and push it. You've seen bad products with great marketing, and they still get the numbers. Mm-hmm. So in our case, just like some of the people have alluded to already, we're in those early stages. So we don't have a really traction of revenue, but it's just been the things we have been doing in some action points, as far as, because we have an apparel company. Like I said, we pivoted to do ancillary businesses. So we have an apparel company by the name of Buddy Love that actually does products in hemp and bamboo, organic clothing that go along with the plant. And then we moved on to CBD and general wellness to keep pivoting on. So my question is, in that, even though you're not showing the revenue, do you actually look at a company for its marketability to say, hey, this thing can take off? Because there are so many within the world of cannabis, there's so many opportunities through ancillary businesses that you can now latch on. And that's what I tell my few people. Hey, we use the Buddy Love name on everything. It's a decal. We're going to be the Diddy of the industry, so to speak. And so I would like your opinion on that, how you feel about that approach going in.
Cool, yeah. And I love the name Buddy Love, by the way. So quick question, are you direct to consumer or are you trying to maybe sell to retail?
Basically, we want to do both. We actually have a piece in there called the Buddy Love Private Club, where we want to do memberships, because once again, you can't sell the cannabis, but at the same time, you're getting small sections that's doing consumption licenses. Or here in Illinois, if you fit under the guidelines, you can get them in. But now we can tie a product to our membership, because we're not selling, we're actually picking up product for them, and they come in and enjoy the process.
Yeah, cool. So yeah, I guess in terms of that, so if you have enough money, if you're raising money, or if you have enough money, you can market your product. That's one way to look at it. But on the other hand, what we look for is, especially now you're at the bootstrapping phase, how scrappy can you be with the resources you have and your own skills to market in a scrappy way? So that's really if you can think of like build on social media, build on TikTok, do like SEO campaigns where you're at the top, this scrappy type of marketing. That's what we like to see. At least me personally, and anyone with a big marketing budget and a marketing hire, anyone could really do that, especially with a good product. That's simple, but it's the scrappiness of the founder we like to see, and the innovative ideas that are outside of the box.
Right, definitely, and that goes in hand, because actually my degree is in film, so that part, that's why I never really worried about what that storytelling or that visual is going to be like. Because I knew we can take care of that. It's just the fact now moving into getting in front of an investor and not really showing those massive numbers as of yet, but looking at the industry as a whole. Hey, we see what it's doing. And so how do we just get in there and put a stamp? Yeah.
Awesome.
All right.
You know, I might want to add, and you might want to add to this as well. Investors like scrappy, resilient founders, because you're going to pivot. It's going to be hard. You've been through it, Nick.
Yeah. And I think that was my biggest skill, is that I was scrappy. I really, you just have to find your way into situations by being resilient. So I guess I could tell a quick story. Eric Adams, he was one of our top clients that we had for my previous company. He just won the Democratic primary. So we've been trying to, so this is going back like over a year ago, like last summer when he first announced he was running. So we tried to get his contract right from the beginning. So I would go to events he was at. One event, I didn't get a chance to talk to him because it was too crowded. I went to a second event that he was hosting. I got to meet him for a few minutes, quickly tell him a few things. Then I went to another event that was like a fundraiser rally, and didn't get to meet him. And it was at the fourth event where I got to sit down and have a really good conversation with his campaign manager. And I was like, these are the data analysis techniques we're using. This is how we can expand your reach tenfold. And they were like, all right, let's set up a meeting. And then once I got on a meeting with him, it took 4 events to go to before I got to sit on a Zoom meeting with him. And also this was in the height of COVID. So like I'm going to these events with like masks on. It's hard to talk. There's this one article that was written. He got in trouble for throwing a fundraiser event. And like there I am right in the New York Post picture, like a funny story, but it was at four events, and then finally got on the Zoom meeting and got that contract. So that's just a little thing in scrappiness where you just got to go for it, no matter what it takes. Just be resilient. If you want something, eventually you'll get it with enough resiliency.
Nick, I have a question about business models, because I know this, you can't have it all thing. I get that. There's, B2C and B2B. And from my company's perspective, we really do want to have a dual business model. Like we are a for-profit company and we absolutely are selling to consumers. However, in the early childhood and early stages space, 2/3 of the population in America cannot find or cannot afford high quality childcare, which means they are actively stressed homes who need what we have to offer but can't afford it. And so I've been really wanting to look at partnering with nonprofits who can be our fiscal backer so that we can apply for some of the grant money that's coming down for early childhood education as a result of COVID. And it has been a political nightmare. So if there's all this red tape, and it goes back to my days in teaching, right? Where you're like being told what to teach instead of just teach your classroom and all that stuff. So anyway, my point and my question is, if you're looking at a deck that says we have a dual business model, do you immediately go, oh, whoa, they're going to spread themselves too thin? Or do you say, oh, I love that there's a for-profit, let's make some money, and a philanthropic side to this too?
Yeah, and then it's a real, and I know all about the political nightmares. Terrible. But the way I see this is, so the second one is strictly philanthropic and like a charity kind of. So
no, I mean, it's still, we still get paid. It's just, so the grant money would subsidize our company's ability to put our curriculum in front of families that can't afford it.
Oh, okay. Yeah, got it. Okay, cool. Yeah, I mean, the way I see it is I love companies that make money, but also do social good. I think that's the direction most VCs are heading to. If I see a company that has a socially positive impact, I'm going to look at that deeper. And even if it's not maybe the best investment, I'm going to try and make it work. Maybe do a little more research to see if there's something that I could make fit. Because I really enjoy that. I know a lot of investors really like those companies. So in terms of the dual business model, no, I wouldn't. If I saw a deck with two business models, I wouldn't immediately think that they would spread themselves too short. But you have to really think in terms of will these two business models make it spread too thin? So like you have to really think, can you actually do this? Can you and your team handle this? And if you say on the deck and you tell an investor, yes, I can handle these two business models and I know that confidently, and I'll put my most effort into both of them, they're not going to be able to argue with that. But something that you could also do is, and this is what I've seen, is start with one business model for the seed round. And as you grow, and mention this on the pitch deck and in the meeting, we're going to expand to this second business model. And I think that's what a lot of companies do, where they focus on that one core one. And then as they experience growth, grow their team, then they expand to that second one. But no one knows the product more than you. And if you have that conviction and you could say that to an investor that we can really do both of these, and I have enough resources to get both of these done, then go for it.
Okay.
That was a good question.
We have a late arrival, Juan Ortega, and I always like everybody to have the opportunity to introduce him or herself. So Juan, do you want to introduce yourself? You're muted right now.
Oh, sure. Sorry. Sorry for hopping in late. But Juan Ortega, Salud Financial, is actually focused on the financial wellness and generational wealth building of the Latino community in the U.S. So essentially, what we're trying to do is close the wealth gap in the Latino community.
Oh, thank you. So do you have any questions while you're?
Great to meet you.
Pleasure. I'm just taking it in. I think a lot of really good questions have been asked, and I think some of the more questions that I had regarding the social good and investment and things like that have definitely been answered. So if I have any more, I'll definitely hop on. So
thank you.
Yeah, absolutely. Thank you.
Actually, there's something I'm gonna drop in the chat, or maybe if I could find it. I have a list of all of the organizations that give grants or equity-free money to social good for-profit companies, there is a lot you could do with that. So I got a small one personally through MIT through an accelerator program there, and it was equity-free, a social good grant, and that was through the MIT Enterprise Forum. So that's one small one, but I have a list of a whole bunch of sort of those equity-free if you're social good, and I definitely suggest checking those out. Yeah, I'll send it, Bonnie. I'll send it to you after. I gotta find it, but and then we could send it out.
Okay, along with the pitch template, which I'll send out to everybody as well.
Yep, of course. But yeah, then that's the thing. Just find any type of funding you can. It doesn't have to be investor funding. And I guess most people can't do friends and family rounds, and that's okay. That's something that like investors will ask you, did you do a friends and family round? And I think that stigma around not doing one is like totally gone. If you look like maybe a few years ago, people would say, oh, why didn't you do a friends and family round? Because, like VCs are very disconnected to regular people. Oh, I don't have friends and family who can give me $50,000. So I think it's coming to a point where that's fine and you don't need to raise that round, and your first checks could come from institutional investors or angel investors. Bonnie, what are your thoughts on that?
I know it's funny because we had an investor who calls them friends, family, and fools. But it's true. And Quartz did a piece about a year or so ago about people who raise friends and family and go on to success. Also, often come from wealthy families.
Mm-hmm.
So I always thought it was disadvantaging a lot of companies that could otherwise have done well.
Mm-hmm.
Yeah. If I can add to that,
sure.
I think one of the reasons for that, which is a tough thing for a lot of people to swallow, including myself, especially because I came from very humble means, is that you need to get to traction before most investors will really take a look at you. That's the truth. And in order to do that, you need capital. That's the reality. So it becomes part of the challenge of making that happen without having capital. And that's what I think a lot of the seed and pre-seed investors really look for, elements of traction. Like, can you convert a flagship customer? Do you have, like those types of things? And that's why I think the fuzziness on traction is a little bit trickier, right?
Mm-hmm.
Because you can make an awesome product and maybe that's your superpower. And maybe with a little bit of capital that would be the big thing. But it's all about how that's defined. I think that's the to me, that's the secret, like in terms of raising money.
Mm-hmm. Yeah, totally agree. And just adding on to that, I think so. I mean, starting a company is not easy and it's expensive, and I really do believe that starting a company is an investment in yourself. So whether that be an investment of time or an investment of capital. So you should really think about where you are in that. And you guys all started companies, so it's too late for this, but this is for more advice for someone wanting to start a company, where we have to know this may take some of my personal capital. This is going to take up a lot of my time, and you have to be ready for that commitment.
Nick, oh, sorry. So you talked earlier about sweat equity and how that actually does hold some value for you guys in your culture that you've created as investors. What about, and the friends family thing is kind of going to the wayside. What about the positioning support that you get from other places? For example, I went through the accelerator program that Bonnie mentioned, and so it was grant money that supported the accelerator program. And as part of that, they backed me to get me some AV equipment, and they covered the first year of our membership platform. And so there was an investment made in my company in a small sense. How would I position that in communicating with investors that there's value there?
Yeah, and that's something I think going through an accelerator, that is the perfect place to start. That sets you up to raise a big round, no matter what the accelerator is. It's a small investment, but it gives you the resources and the connections necessary to raise that round. So in terms of you, I mean, money is money. You can say that, and just the fact that it was a grant money doesn't really matter, because you were given that capital because of the amazing work you're doing, which is the same thing. So grant money, grants also have shareholders. So the people who donated the grant money want to know where that grant is going to. So it's really not just free money, because there still is that responsibility, the same way that there is responsibility with equity. So it's a really great thing to get grant money. And you should definitely, and one more thing on that, you should definitely tell the investors. And the fact that you got grant money now means that there's the potential to get grant money in the future. And grant money is equity-free capital, and investors love that.
You know, in fact, we've had, I'm sorry, I just wanted to add one thing, Kara. I didn't mean to interrupt. Apologies. We had an investor a couple of years ago, and one of the attendees, you know, presented her startup, and she said, also mentioned that they'd raised over $2 million in grant money, and he said to her, "Send me your deck right now."
Nice.
Okay.
Yeah. So I guess, you know, for me, authenticity is key. And so even though I didn't apply for that grant, but I was a beneficiary of it, it's okay to say that grant money supported us.
I think so. Yeah.
Okay.
I don't know the technicality, but I mean, if it went to your company, I mean, I guess, and it supported your company, I guess that would make sense. I'm not too much of an expert on but yeah, I mean, that makes sense. And they're really not going to dig too much into it. I mean, if it supported your company, I guess that's a grant.
Okay.
Yeah.
Thank you.
Nick, would you mind you talked about, when we were in the clubhouse, you talked a lot about how you pick your partners and the importance of that, because many companies are getting multiple partners investing. Would you talk a little bit about that? Because as you know, Bonnie likes to talk about the fact that it's harder to get out of than a marriage. So yes. Talk a little bit about it, how to pick those partners, and what startups can do to pick better partners early so they get better partners later as well.
Mm-hmm. And partners in terms of like co-investors?
Yeah, because co-investors is an interesting topic that there's not a lot of knowledge out there on, because it's kind of a secret. So would you share a little bit?
Mm-hmm. And I think this goes to my point earlier on too, where I told the story about the founder who wasn't very nice. You also don't want to work with investors who aren't very nice. You want to have a good relationship with your partners. And then something we also like, if it's Sequoia or like one of the or like Andreessen Horowitz, that's the situation where, okay, we'll take you as an investment partner, kind of on whatever terms, no questions asked, because you want that deep connection to the firm that's getting a lot of really solid deal flow. But on the basis of when it's more of an equal partnership where me and the co-founders are taking about the same amount of equity, you really want to choose strategically, and investors that, one, can bring you more deal flow, and two, investors that support the portfolio company. You don't really want investors who are just check investors and then step away and then come back for when the exit happens. You really do want those value add to both our firm and the portfolio company. So you really just want to look for really well-rounded partners.
It's called smart money.
Smart money.
As opposed to just taking money from anybody.
And then you have to think, if the terms are totally ridiculous, do we take Sequoia? Do we take a Sequoia deal? I don't know, probably, but that's it's tough to say.
I'll always be willing to walk away.
Yeah, of course, yeah.
Next question.
I guess I'd love to hear more about like some of your experiences, if you want to talk about it as founders.
Yeah, I'll jump
the
in.
hardships you're going through and what help you might need.
Yeah.
Yeah, I'll definitely jump in on that. The hardest thing really is taking on all the hats, doing everything yourself. Mm-hmm. I'm listening to a lot of people talking about their bringing on team members. You know, you have people that say, hey, man, I want to join you. But then when they see the work you're actually putting in, and it's not so glamorous after a while. So it's like, I find myself at times a little drained, a little drained because of the efforts putting in to go out and, just like you were saying earlier, as opposed to doing a product or meeting people, and going out to advance the company. So that's the hardest thing, of just trying to really find the right people for the right position to actually have that team play, because, I know this thing is not going to move any further along if I don't get the right players on board to do specific jobs and let me be me, my charismatic self, smiling, talking to people. And that's hard to do if I'm constantly, strapped to this computer, man. And make us obey, I want to add this as well. I actually have another company, an apparel company, that I've been working to build out the last 5 years with my partner that used to work for Nike over 6 years. So that's my baby. I really don't talk about that one too much because I get personal. But it's the same difference though, man. It's just finding people to really come on board to do the thing, because now we're at the gate, we're off and running, and it's like my trust value. Why are you truly here? Now after I've done all this. So that's just a difficult thing for me at this stage. As we move forward into getting into the revenue pieces,
Yeah. And I think that's actually the hardest part of being a founder. More difficult than building your product, more difficult than sales, more difficult than raising money is recruiting talent. No one really knows how to do it. I don't really know how to do it. It's because it's hard. It's not easy. You have to convince a person who could have this multi-six-figure job with benefits at some big tech company or some big apparel brand that, hey, come work for me for less money, but here's equity. And that's not easy to do, because that's really being persuasive and conveying your mission onto them. And investors, it's easy because they're looking for investments, but that talent is really hard to recruit. And if you get good at that, I think that's the ultimate skill, because it translates to everything else.
Exactly. And even with you saying that, even a portion as far as bringing them in to actually get a stock option, what does that look like? Do I spread that out through an S Corp series into 1,000 shares and split it out? It's like I thought that far, but I haven't, because I'm so caught up with everything else, especially when cannabis, because it's a lot of legalities. And things, even with CBD as well, that I'm learning that you have to jump through these hoops, man. And it's a handful. So it's like I have to push something to the side to actually stay on point with the legalities of what we're doing,
Yeah. And then that's the thing. There's two ways to look at it, where top talent is going to want some equity, but there's also the opportunity. Maybe you could, if you don't need that much help, maybe you could just bring in contract workers who are, so that's another way to go about it. But top talent, you would sort of have to figure out that equity, what's fair, what's not. And that's a whole lot of research especially in your industry.
Definitely.
So I don't know if this is helpful to anybody, but I'll start by saying I have been unbelievably blessed. I call them universal clicks. Things are just clicking. The right people are being attracted to this, and they're jiving with the mission and the company culture, and they're signing on to be helpful for $0. Now, that said, and we're getting a lot done. It's amazing. Nick, when I approach an investor and my deck shows this diverse, well-qualified team, and I know that I finally want to pay them some money, how much of our ask do you find acceptable for me to say, this is going to go into payroll? I need to pay these people some money.
Good question. So unless it's ridiculous, then it's fine. So there was one company we saw, it was a bridge round between a Series A and a Series B, but the founders were making $50,000 a month. They were paying themselves. That was the request. That's absurd for an early stage company with 20 clients. That's not really the route to take. With that being said, you want I mean, a livable, comfortable wage to secure top talent, but nothing like crazy absurd. It's not right now. It's not a big tech company where they will get that equity slice, but I think enough to secure the top talent. And what that number is, I'm not sure, but you don't want to. I guess the answer is a little below the industry standard, what they would make at a big company, where you want to keep them, but don't pay them too much, right? I guess that makes sense.
Well, what's your take on the founder falling on their proverbial sword, right? When the founder says, I'm willing to work for next to nothing so that my team can get paid, does it worry you?
I don't know. I think that it has to be a comfortable founder, and where the founder shouldn't be taking huge, like, because by the next round they'll take maybe a payout. I don't think, as long as it's a comfortable wage that the founder feels comfortable with, maybe they can take a slight pay cut for that more talent, but I wouldn't say totally like fall on the sword and do be too extreme, where you want everyone in the situation happy, but understanding that this still is a startup and there's a lot of growth that could take place, and the salary will be nothing compared to what the equity will be worth.
Okay.
You know, I have a fun little story. Oh, I'm sorry, Kara. I keep interrupting you. I just
You're so fine, Bonnie. I'm a chatter too. But my final question on this topic is, I love numbers and ratios because they are very easy to wrap my head around. So is there a ratio of salary to other expenditures of money that you like to see inside the ask? So if you're asking for $500,000, what's the max you really want to see going out in budget salary?
This number is very dependent on company. So if it's a company with a low customer acquisition cost and super low, and the LTV to CAC is like really high, yeah, sure, pay your founders more. You don't need much of a marketing budget or customer acquisition budget. So yeah, that's fine. Pay your founders as much as you need to really be comfortable with the round. And I think that's industry dependent. And the real thing there is, as long as it's not like absurd and it's dependent on company traction, if you really put in a lot of sweat equity and you're getting a lot of fast traction, then sure, pay yourself a little more. But as long as it's fair, and I think maybe slightly below what like a big industry is paying, then I think it's fair. But there's no actual ratio because every company is different in their spend. Oh, you're muted.
Unless somebody else has, I just had a fun little story to share, where there was a company that was launching, and they had raised a little bit of money, and they really needed a very strong regulatory expert. So they targeted one and approached this person, and offered him some money. And he looked at the company and he thought about the regulations and how much work was involved. And he said, "I'll take equity instead." So Brad Tusk ended up walking away from his little consulting gig with Uber, $100 million richer. I'm sure you know that story, right, Nick?
Oh yeah.
Oh yeah. So anybody else, and now has Tusk Ventures. So next question. We have time for Sure.
I was just going to wrap up and say that's a great point. And it speaks to, I think, something else we've been talking about this whole morning, which is the traction you can show or other positive impact you can show with the team that you build, right? It shows belief in what you're building. It shows belief in you as a founder. So my COO, for example, was the former CEO of H&M Mexico. And similarly, at the time, this was last year, had no salary to pay him, right? And he's, way up here. And he really wanted to do something he believed in. He believed in what we're doing. And so he came on just for equity, for no salary, until we raise our first round. And so I think that also is part of the story, goes to investors, and exactly what you were both just saying.
That's actually really strong. That you have that person coming on with no pay. That's a really strong story you could tell, and that investors will like that. So
we have a few minutes left. Oh, Scott.
Yeah, I just got a question for Nick that's actually a little bit off topic, but you said that you had started out by having developing something to help the people in politics to look at statistics. I'm curious that because I've sort of been close to politics most of my life. One of my best friends was a congressman, and my wife started out after college as a political consulting company in Philadelphia area, and it wound up leading her to working in the White House as a special assistant to the president. So we've been around the politics a lot. So what you were talking about, I'm curious, is there a link to, I'm sure the company's still in business?
Yeah, so I could put you in, so what the company does is it's based on, it's IP based polling. So the way polling is done is it's very dinosaur. It's, you make phone calls, you do robocalls. So we do IP based digital polls with demographic breakdowns, or we did. So a political consulting firm bought it, and I could definitely connect you with them offline if you want to. I don't know. I think they're pivoting slightly where I'm not quite sure what their use case is. I think they're using it for like the governor's race right now, but I'll definitely connect you with them when we connect offline.
Because a good friend of ours is still a political consultant in Philadelphia, and it might be something he might be interested in as well.
Yeah. Mm-hmm. I think the point is they wanted the sole license of it. So I was working with a vast amount of political consulting firms. So they kind of wanted the value add that they're the political consulting firm with it, but maybe they license the software. I'll connect you.
Okay, thank you.
Cool. But yeah, politics is, I'm happy to be out of that industry, at least for a little while.
Oh yeah. Yeah. Try not to talk about it when you have family or friends over.
I was in a good place where I didn't have to get political with people, where I was just the data supplier, but it was interesting. People really backstab each other it's crazy. I've seen some crazy things.
Well, yeah, I had thought about earlier getting involved when my friend was first in New Jersey. We have these things called, well, they changed the name. They call them freeholders. And he first started out as a freeholder. And then when I saw what he was going through, and then especially what he went through as a congressman, I said, I don't really want any part of that. It's not worth it.
Yeah. I was thinking of running for office, but not yet.
You think it's something you might do in the future?
I think so. I think I'd be pretty good. I think I'm a people person. I think I could get votes, but I think so. I think it's somewhere soon, maybe not too soon, but I think it'd be fun to at least give it a try.
Yeah, it's really tough to go in. I have some friends who say they believe in term limits because people go in with initially, no matter which party, to do good things, and then after a few elections, then it becomes about getting reelected. Mm-hmm. And not as much about, helping the people. Because I really think pretty much everybody gets involved with good intentions, no matter which party. It's just that what happens after you're there for a while.
Mm-hmm. Yeah, exactly. But Bonnie, you ever want to close us out or what's Oh,
yes, I was going to ask you if you want to leave us with some sage words of wisdom and encouragement.
Yes, and I just want to say thank you all so much. This was so much fun. I really liked getting to know you all. I think, did you all you want me to write it one more time, my email? Sure. You guys have it? Hold on, let me make sure you have it. So I'd love for all of you to send me an email. We'll connect offline. There it is. And love to know more, go deeper, offer any more advice I can. And yeah, you're all building amazing things. And it was so great hearing about it. And I really enjoyed it. And thank you for taking the time. And Bonnie, thank you so much. It's always a pleasure.
I know.
I'll be on Clubhouse more just for you. I'm gonna come back to Clubhouse.
I'm gonna tap you into our Clubhouse room so you can join us again. Nick joined us in one of our Startup One Stop Clubhouse rooms, which I also list in the newsletter. You'll do that, right?
Yeah, and everyone else come. Yeah, ping me into one. I know when they are too, so I'll be in the next one.
Okay, thank you. I'll include in the newsletter. Thank you, everybody. Thank you, Nick. This was fun. Plus, I always love your energy. It's always fun.
I like to have a pretty good energy, and that's awesome. And if anyone's in New York City, let's grab a coffee or a lunch or a drink or something. Would love to do that.